what is the importance of proper allocation in this?
Proper allocation actually gives you a better picture. How much money is each dental practice actually making?
How often should multi-practice owners review each location's numbers?
I would say each month.
So what exactly are the issues come up that usually stays hidden when you separate the P&L?
When you separate them, it's like a microscope. You have to go wide lens sometimes, and you have to, as a business owner of 5 practices or 10 practices, okay, what's the group doing as a whole?
So what's a red flag that one office may be underperforming?
You have to start with collections. Now, if there's a very specific reason that one entity is doing really good or the other entity is not doing so good,
DJ, welcome back to another podcast.
thank you.
How are you doing today?
Pretty good.
In our previous podcast, we had discussed about multi-practice owners multiple times. So in this podcast, I want to completely dedicate this podcast to multi-practice owners and discuss what are the mistakes that they make and how is it different from solo practice owners and how they can be more profitable.
Okay, yeah, let's talk about that.
So first of all, why are multiple practice owners at higher risk compared to the solo ones?
Multiple practice ownership is a whole different ballgame than a single owner. When you're the single owner, it's a business, but is it truly a business? To a certain extent, I feel like you have a business, but it's more of, okay, you've created a job for yourself where you're your own boss. It's kind of sort of that way. Multiple practice ownership is where you truly have a business, because you might have another location or 2 or 3 or 5 locations where you're not even there. So that's where you have to create systems. You have to have the right team. You have to have ways to monitor those 5 locations. And you can't just leave your location to go and rescue another location, because you have to do your work. You have to focus on your location and do the production over there. And sometimes multi-practice owners don't even produce anymore. All they do is manage the dental practices, keep an eye on what is being produced, what are the KPIs, what are the numbers I, as the CFO, needs to look at and make sure all these 5 other locations are doing and how to make them more profitable. It's a more complex business, because you can't be the hero of each and every location. You have to find other heroes to help you out. You have to find team members. There's more risk. There's more money involved. You have more commitments. You have to pay rent for 5 locations now. You have to be able to make payroll for, if you have 5 locations, maybe 25 employees, maybe 30 employees. So it's more complicated. There's more risk for the owner. If multiple locations have loans, you are obligated to make those payments. So there's more at risk. So it's a whole different ballgame when you go from a solo owner to multi-practice ownership.
Okay, so what's the biggest mistake that you see multi-location owners make in their financial reporting?
Well, it's more from an analysis standpoint is what we see. I think most of the times the CPA or the bookkeeper will do a good job of reporting the correct numbers. But what comes into question is, what's the focus? Okay. So let me be very clear. I think each and every practice location needs to have its own set of financial statements.
Okay.
It needs to be separated out. Each location needs to have its own P&L showing what's the revenue, what are the expenses. If that's what you have, at least you're going the right direction. But if you are only focusing on the totals, okay, if you're only focusing on what was my total collections through all the practices, what were my payroll expenses through all the practices, and what are the supplies, and so on and so forth, then you're getting maybe a prettier picture, maybe an uglier picture. You just don't know, because you might have practice A doing really well and practice B dragging the other 4 down. In this example of 5 practices, if you stick to that, then what happens is you don't know which one is dragging you down if you just look at the totals. So that's a big concern for me, or I feel like the owner needs to go a little bit deeper to figure out, okay, hey, which of my practices are doing really well, which ones are not.
Okay, so every location should have its own P&L.
Oh, for sure. Yeah. If you don't have visibility into each location, it's really hard to figure out what needs to be fixed. Look at the totals and see how is it doing as a group, okay? But then go deeper and figure out, okay, hey, what are the collections for practice A? What percentage of payroll is practice A costing me? How much are we spending on dental supplies? What percentage is going to dental supplies? What percentage is going to lab costs? And for example, if you have 5 dental practices that you own, then you need to see all those 5 on one sheet and then go one by one, okay? And then you will figure out, okay, if practice A is $1.5 million in collections for that specific year, practice B is $800,000, practice C is 1.75, you know which ones are doing good and which one needs improvement. Now, if practice B at $800,000 is a newer practice, and it's reasonable for it to be less than the others. If it is a 5-year-old practice like the others, then why is it still $800,000?
Right.
If you just look at the total, you're not going to know which one is not producing or which one's not collecting as much as the others. So if you separate out the P&Ls, you know which one's not doing as well from a collection standpoint. Now you go back to that, okay, or what can I, as a dental practice owner or an owner of all these practices, what can I do to make that number go up? If I have a team member in practice A that is really good at increasing collections and doing better from a case acceptance standpoint and those things, maybe we have that person look at practice B and help figure out what can be changed or what can be improved in practice B to make that $800,000 also go to $1.5 million or whatever the number you're shooting for. So it's really helpful to figure out, okay, which one which numbers need to be improved in which practice. Let's go to practice C. Okay, let's say practice C is doing $1 million, but the payroll over there is 40%. Okay, the rest of the practices are at 30% or 25%. Why is this at 40%? Okay, if you don't keep them separate, if you don't keep the P&L separate for each of those practices, you're not going to know. You just have the one big total number, and then you're like, okay, hey, we're trying to improve the profitability of the group, but we just don't know where to look. The separated thing tells you where you need to look. You look at the percentages of each practice, and if one is more than the others, then you look at, okay, what's the issue? How can we improve this? You talk to the staff on location A, maybe they can help out location B, train them a little better, and so on and so forth. So there's a lot of benefit to separating them out.
Okay, so what exactly are the issues that come up that usually stays hidden when you separate the P&L?
When you separate them, it's like a microscope. I mean, you have to go wide lens sometimes, and you have to, as a business owner of 5 practices or 10 practices, okay, what's the group doing as a whole? You have to look at that. But then you have to zoom in sometimes and zoom in each of those practices and be like, okay, where can I improve? Is my dental supplies in line with the rest of the other practices? Are my total dental supplies in line with the benchmarking of in the dental industry? So you have to look at those things. And then sometimes as simple as looking at those percentages, because if other dental practices in the group are around 5%, there's one which is at around 8%. What's going on? Are they not stocking the dental supplies properly? Do they just go, put the stuff in their drawers and everything is just goes on the top, and the things at the back of the drawer are expiring? So when you start to look at those, you're like, okay, yeah, the systems of refilling the drawers is not correct, or there are gas cylinders in the back that you're not using, and instead of maybe paying rent for 2 cylinders, you're paying rent for like 5 or 6 because you just didn't return those things. It's just those things come to light, and you start to figure out, okay, hey, this is 8%. Let's go back. Why is it 8%?
Right.
Who are the vendors we are paying here? Is something going on with the person who's ordering supplies over there? Do they have, a special relationship with the salesperson or whatever? So those things come to light. And I'm not saying there's fraud or anything in that case, but who knows?
Right.
If you don't look at those numbers, you're never going to know. If you just look at the total, 8% over 5 practices is not going to make a huge difference when you divide it
Right.
by all those. But if you look at one specific, and that thing is going to jump out and be like, okay, everybody else is 4.5. This location is 8. We need to look at it a little bit closer. So it gives you in detail where exactly do you start looking and improving each location.
Okay, so let's discuss more of it. How can one location quietly lose money without the owner even realizing it?
So if you just look at the totals, what might happen is that, as we just discussed, that location B is getting paid, is collecting $800,000, but that location might be spending a lot more on payroll. But when it's just lumped in, you're not seeing what's happening. Okay, and that location is losing your money. So each and every location, you need to look at the details. You need to look at what is in that specific P&L column for that location. The way we do bookkeeping for our clients is all those 5 locations have the same chart of accounts, same exact chart of accounts. Okay, so when we pull up the P&L for all those together, you can see each line value for an expense for that period of time. So let's say if you're pulling P&L, the combined P&L for all the practices in your group, you will see, okay, hey, merchant services, $17,000 to location A, $12,000 for location B, $15,000 for location 3, C, whatever the case might be. So you're looking at those very specific numbers for each and every dental practice. But if you just look at the total and don't bother to look at the details, then one location might be overspending on certain expenses. They got all lumped up. The overall picture still might look pretty because location A was doing so well that it took care of whatever
Right.
the shortfalls that location B had. You need to look at them individually to figure out which one's doing good for you and how to improve the ones that are not doing so well.
Okay, so what's a red flag that one office may be underperforming?
You have to start with collections. Now, if there's a very specific reason that one entity is doing really good or the other entity is not doing so good, let's say just for the reason of, the other entity is brand new or has been in business for a shorter period of time, maybe a year or year and a half, then yes, the collections are going to be lower because it doesn't quite have the patient base that the first one has.
Right.
Okay. So yeah, those are reasonable things to think about and it makes sense. But if they're all, of the same age and same number of ops and doing the same exact thing from a dentistry standpoint, then you would imagine they would be very close to each other. Yes, the demographics matter. Yes, the location of the practice matters, that, okay, what kind of location are you in? But, you will know that, okay, hey, this location is not as good because the demographic is different, or we're not spending so much on marketing over here, and so on and so forth. So, but then what the issues are, and then you can fix those issues. The other thing you need to look at is the percentages you're spending on each and every expense category, okay? If all the dental practices that you have, or the 5 of them you have, 4 of them are at about 28%, but one of them is at about 35%, you already know there's an issue. When you look at that, that's a big spike compared to the others. What's going on? Do we have an extra person there that we don't need? Is there something going on where somebody's just hanging out and twiddling their thumbs? And then the practice manager, you can talk to the practice manager and be like, okay, how do we fix this? Do we have an extra person?
Okay.
And make that practice more profitable as well. So look at those lines and figure out the percentage parts. Now, if rent is higher, it's higher. You can't change the rent. And that's something when you sign the lease, you knew that, okay, the rent for this location was going to be more. When you sign the lease, you knew, okay, we have more ops in this place. So the production is going to grow where that expense percentage for facilities expense is going to come in line with the others. You just need to put in more effort to grow the top line revenue for that specific location. But look at those percentages each month, compare those percentages each month to the other practices that you have in that group, and then you'll figure out, okay, hey, which one do I need to focus on? And those are the red flags.
And we often get to hear about a term which is overhead distortions. What do you mean by overhead distortions?
Some of the bigger practice groups, what happens is they form a separate entity and they move some of the common functions to that entity. Okay.
Okay.
So they might have a regional practice manager who overlooks multiple practices. It could be 2 practices, it could be 3 practices, it could be more than that.
Okay.
Those expenses will typically go in that management company, the new entity they've created to manage these dental practices. They will start to pay sometimes the advertising in there, software subscriptions in there. Okay. Now, it's a good idea to reallocate those to each of those other practices to figure out what is the true profit of each of these practices. At the least, when you get the combined P&L, you need to make sure that, okay, hey, we include the management company's P&L and those numbers in the report so that you can say, okay, hey, yes, we do see that the payroll is X percentages, but we also see that, okay, then the management company also spend money in this. And if you look at the total column for the group, you see, okay, the percentage you're spending on payroll is more than per each location because now you've added the management services in there. Okay. Now, yes, you can allocate that as well. Maybe you should, but it comes down to cost benefit analysis. When you allocate that stuff, then your accountant is probably going to charge you a little bit more fee. But that's part of it because that's more work for the accountant.
Okay. And what is the importance of proper allocation in this?
Proper allocation actually tells you, gives you a better picture that, okay, you know, how much money is each dental practice actually making? How much money is each location making? If you have a software subscription and you just allocate it to one entity, then it is hard to figure out, okay, hey, which one, if you have multiple doctors working in location 1 and just one doctor working in location 2. And what happens is you might have subscription based on doctors and you should allocate more to location 1 compared to location 2.
Right.
What we recommend is use different credit cards for each location. That's what you need to do. And yes, it might cost you a little bit more, but then you have a clear picture what each and every dental practice is paying. Okay. And you have to, maybe sometimes it's not going to even cost you more. You just talk to the vendor and be like, okay, yes, this is one invoice, but we're going to pay it from different dental practices based on what needs to be allocated to those dental practices. So you can do that as well. But it is a good idea to allocate them by location.
So, how often should multi-practice owners review each location's numbers?
I would say each month. I mean, you have to look at those numbers each month. The moment you lose track of those numbers, you're dragging the inefficiencies for a longer period of time. Okay. So maybe you can get your accountant to get you a combined P&L from a 12-month trailing basis. So, hey, if you're in March, what's my 12-month trailing P&L? Okay. So you can go back from April of previous year to March end of this year. That is 12 months. Now you know, okay, hey, what are the trailing percentages for each of my locations? And are they in line with each other, or we have a couple of locations that are off? So you need to look at them each month.
Okay.
You need to look at the comparisons and make sure they're similar and not too far off from each other. Okay. Look at, hey, the collections. Okay. Are they in line with each other? Should we be able to improve on certain location? Look at the payroll percentages. Are they in line, or is one location paying a lot more than the others? If there are very specific reasons, they should make sense to you. But if there's no reason, you need to drill down further and figure out why that's the case. Same thing with dental supplies and lab costs. If you do not get a combined P&L, okay, then what happens is it's really hard to figure out and pinpoint which location is not doing so good for you. Let's say if you have 5 dental practices, you have to look at one dental practice and you have to look at the second one. And by the time you get to the 4th one, you've already forgotten what you had in the first dental location. Okay. If you get a combined P&L, it's very simple. You can get an Excel format, you can get a PDF format. You can look at it in one, fairly easily. Okay, where is the money being spent? What location needs to be improved? And what category needs to be improved? And then, you can make those adjustments in an ongoing basis. If you get those things once every 6 months, something might have gone wrong in month one, and you've had it lingering for 5 additional months, and you might take another 2 months to fix it. That specific practice which has been lingering, if it's $1 million practice and you've been off on the expense percentage by 2%, that's $20,000. That means in the 6 months that it's been lingering, you lost $10,000. These percentages eventually lead to actual numbers, actual cash that is leaving these practices, hence lowering the profitability of your group. So you have to look at them really closely. And as I said, you need to do them month by month.
Okay. So if each practice has separate books, why is consolidated report still important?
You need to have a complete picture. You need to know how much money are we making. You need to have a complete picture. The banks want to see it. I mean, any loaning institution who's going to give you more money to build a new practice is going to want to see that. You may want to see it too. Okay, I have this whole thing. It's just harder if the information is segregated and you're not getting a complete picture to figure out, okay, what are my totals looking like?
Okay.
As we started this discussion, why only look at combined numbers is not a good idea. The keyword is only. Okay, you do have to look at the total numbers. Okay, you should look at the total numbers as a group. How are we doing? But you need to go inside and dig deeper sometimes.
Okay.
Banks want to see that. At the end of the day, these financial statements are also going to be used by your tax accountant to file your tax return. If they can see the combined picture in one go, they might have a better tax strategy for you and how to shift things around so that you can make better tax moves as well. If they have to combine those things, keep in mind, it takes effort to do that if you're doing that in Excel, and there's more probability for errors. And the accountant, the tax CPA, is going to charge you more to combine these things as well, because now they're working on 5 different financial statements instead of one picture which tells you what the totals are.
Okay. So what does a good combined report looks like? What does it consist?
How we do it is this way. When you're a solo practice owner, we have very specific categories that we want to put the expenses in. Okay, we have an employee expense bucket,
Okay.
where hygienists go, assistants go, managers go. Anything related to payroll taxes related to those specific employees go in there. Associate dentists and specialists do not go in that category. Okay, this is the bucket for non-dentists and non-owners. That's where those expenses go. We have a facilities expense, we have professional supplies expense, we have an associate expense category. So we put those in those very specific categories. We do the same thing for all the dental practices. We do the same thing for location A, location B, location C. Now, when you combine these things, all these practices need to have the same exact chart of accounts, so that when you see them on one sheet of paper or one Excel file, it makes sense. Okay. So the way we do it is, hey, on the left you have the accounts, then you go by location 1, what are the revenue and expenses for that, the percentages related to that, then location 2, and then you have income and expense related to that, percentages related to that, and you see all the way through 5 practices or whatever. You may have 10 practices all the way through, and then you will see a total column and the percentages related to that. Okay, this way it gives you a good picture of what the whole picture looks like, and also if you want to dig deeper into individual practices, it's easy to figure out what's in that. That's how it typically looks like. We will have a link in the show notes below where you can see a sample report.
Now, what is the biggest financial advantage of structured reporting when it comes to a multi-location owner?
There are a few advantages. Okay, biggest one is that when things start to go bad for one specific location, you detect that early. The sooner you detect issues, the sooner you can fix them. Okay, so that's one of the main things. Like, okay, this location has 8% in dental supplies. The others have 4.5%. why is this so much more than the others? So that's the biggest thing. You detect things early and you can fix them early. Next thing is, if you know one practice is doing really, really well compared to the others, you can start to be like, what are we doing at this specific location that this specific location is way more profitable than the other four? You can go back and try to figure out what's the formula over there. And then if there's a specific formula that does make that practice more money, you can try to replicate it to the other four practices. Okay. If you are trying to expand, then again, going back to if you know one of those practices is doing really well, when you open a new location, you're going to be like, okay, this is the practice we want to replicate over and over and over again.
Right.
Is it going to be exactly the same? Probably not. It's a different location. It's going to have its own quirks, but you can try to be as close as to the first one, which is making you really good money, and replicate it in the next one, the new ones.
Okay.
And then when you ever decide that I want to sell this thing, okay, what happens is if you have proper structured financial statements and you have them for a long period of time, then what happens is you get a better valuation for your group because the buyer can go back and look at, okay, hey, they have had these financial statements from a consistent standpoint. We can go back look at these reports and see what were the percentages for payroll and other items in the past as well. So the buyer deems the risk to be lower when they can actually see those numbers on an ongoing basis. So there's a lot of benefit to having structured financial statements for multiple groups, especially in a combined format.
Thank you so much, DJ, for this another very insightful and a wonderful podcast. Thank you so much for coming.
Thank you very much. Take care.